Hello, everybody. Brian here, quantlabs.net. Just want to go over another the criteria. This one's really important. I first learned about this in Ernie Chan's book back in '08, no, probably '08, 2010, and all the way back there. And this was I found through Ernie Chan's book, Dr. Ernie Chan, and his How to Build an Algo Trading Business. Um, from a mathematical standpoint, you can use this criterion formula to help build out both risk management along with your building wealth with this. Because it'll help, and this is all it self adapts. So you can use this to throttle your trading accounts. Kind of like, well, let me go over the purposes. So we all know about the famous Black-Scholes model versus Kelly criterion. So this article here found on cointelegraph.com. I'll put this into my blog post. We can see here, and I'm going to be more probably looking into futures trading and options trading down the line, where Black-Scholes is used for that. For as you can see here for options, um, and Kelly criterion is really more universal for risk management, including crypto as well. And the applications is said for Black-Scholes used for option pricing. For Kelly criterion is more for position sizing. So the history of Kelly criterion, from what I understand, is it's from horse betting. So when people went out and betted on the horse racing, they would use this criterion to know how much they will put at risk based upon their trading performance. So if they're going through a streak of winning, they'll add more to each bet or each new open position because they're performing better based upon market conditions. If they're better than what were, let's say, during a recession, if the markets are performing badly and your trading account's performing badly, you can automatically set smaller position sizes so that your risk is lower if you do have more losing positions. That's the whole point of it. Obviously, the purpose of it is with the Black-Scholes, just a simple, I shouldn't say simple, it's quite um, adaptive pricing model. But here is what you want to pay attention to on the Kelly criterion is you want to have this built in. You can't really do this manually. Uh, and You would use this for maximizing wealth. Okay, that's what it's really meant for. So then you would have, if you've heard about factor investing, a lot of big firms use this when they assess, let's say, stock to trade. This would be added to as part of those factors because, like with Black-Scholes, it can pump out various results using Black-Scholes, whereas Kelly Criterion, as I said, will give you the position size or the bet. I mean, it's the same thing, really. And if it's, as I said, better performance from prior activity, you'll have a higher bet size or position size. Um, and this can be applied to any asset class that you want. So I just want to talk about that overall. It's a very good technique to measure your trades before you take on positions. Um, because if you're doing well, you want higher betting, higher, bigger position sizing. So there's things to understand. And again, you can really only do this optimally through some form of automation on whatever platform you use, even if you build out your own. Okay, I just wanted to let you know about that. As I said, if you want to know more information, follow along with other stuff I put out. You can join my email list, get some free PDFs as well. Trading quantlabs.net/books. In the description, I'll also give you my Discord group. I'm trying to really build out a community in there. I've also put out all kinds of news in the crypto space, quant trading, programming, forex, equity, and trading generally. I put news out on there. Also in the Substack, which I'll put the link on. If you want to know what I'm trading or what I suggest, you might want to check out the Substack at Quant Labs as well. Okay, and we'll leave it at that. Thanks for watching. Have a good day.